Morning. So we're just going to wait for 1 or 2 more minutes while more participants join, and we will start our public hearing soon. Just thank you for joining and for your patience for another minute or so. Okay, so good morning to all. Welcome to today's public hearing on on the review of the insurance disclosures under Article 8 of the Taxonomy Regulation. So today we will be focusing on the public consultation that EIOPA is running on this topic. My name is Carlos Guiné. I'm the head of sustainability at EIOPA, and I will have the pleasure to moderate the session today and guide you through the event. So to start, just a brief overview of today's public hearing. We will be organizing the discussion today across 3 different sessions, followed by some welcome remarks by Patrick Hodges, our head of policy and supervisory convergence department here at EIOPA. And then throughout these 3 sessions, we will cover, let's say, the main areas of the consultation document that is currently available to all of you. So we will start with the proposals concerning the current underwriting KPI, the combined insurance KPIs, and some other targeted simplifications that are proposed in the consultation document. We will then have a short coffee break, followed by a dedicated session on one of the core topics of the call for advice, which is this exploration possibility to introduce a green insured activities KPI. And then last but not least, we will have a session touching on the topics that are horizontal, so cross-sectoral, which, as you may have also already seen, have been, of course, coordinated with our colleagues from the banking and the asset management sector for these topics. And we will end with some quick closing remarks and an indication of next steps. So this is the plan for today. Then we will have some presentations for each of the sessions that will be provided by the colleagues you see there on the screen. But the main focus of today will, of course, be to give you an opportunity to ask any questions you may have, to, of course, allow you to clarify any points, and we will try to keep as much time as possible to Q&As and exchanges with the participants on the different topics that we will be presenting. So then if we go to the next slide, just to give you a quick notice for you, of course, all to be aware that this event is being recorded using the Microsoft Teams, and we will make the recording available also via our EIOPA website. So you can review the meeting later if you don't have the opportunity also to participate in all of it. You can, of course, also share it and invite other colleagues who could not join today to review it. So for the Q&A, of course, you will have the opportunity to submit questions without disclosing your name, having in mind the recording that is taking place. Then just on the next slide, some practical points. So we will be basically running this as a virtual session. If you have any troubles with your connection, please try refreshing, rejoining, or you can also, of course, drop us in the Q&A some notice if you spot any issue with the sound or any problem from our side. And last but not least, from my side, just to make a reference to the Q&A on the next slide. So we will be let's say, to keep the session as streamlined and practical to all participants as possible. We will be collecting your questions via the Q&A function on the Teams town hall that you can see on your screen at the top. Basically, the questions will be moderated, which means we will only publish the question. We will review the questions before they are published, and we will do our best, of course, to cover as many questions as we can, given the time available. And as usual, you will have the opportunity to support, upvote questions that are put forward by other participants. To keep it also a bit more manageable on our side, we would really ask you to focus your questions to the session that they are referring to. So we will have 3 Q&A sessions after each of the topics are presented, and we would ask you to try to keep your questions focused on that specific topic that was presented, so that we can keep the flow of the session also more manageable from our side. With that, I would now give the floor to Patrick Hodges, EIOPA's head of Policy and Supervisory Convergence Department, for some opening remarks and some welcoming remarks to all of you. Thank you so much. Patrick,
thank you, Carlos. Yes, thank you, Carlos. And good morning to all. A pleasure from my side to open EIOPA's public hearing on the review of the insurance taxonomy disclosures. As you know, the EIOPA has, together with the other ESAs, received a call for technical advice on the review of the disclosures under the delegated, under Article 8 of the Taxonomy Regulation. So thanks again for joining us today for this public hearing, which I think is an excellent opportunity to share our thoughts on this important topic. Just to allow me to provide you a few remarks to give a bit of an overview of the topic in a wider context. Over the past few years, Europe has built a comprehensive sustainable finance framework. Sustainability disclosures have played a central role in this effort, strengthening transparency, supporting investment decisions, and accelerating the transitions to a more sustainable economy. The taxonomy disclosures are a key tool for measuring sustainability in Europe, grounded in science. And for insurers, The disclosures provide transparency on their contribution to climate adaptation to reduce impacts of natural catastrophe risks, as well as provide a look-through to how environmentally sustainable their investments are. Now, EIOPA's commitment to the green transition is strong. The risks are increasing and need to be addressed, but in a way that caters for simplification and burden reduction. For insurance undertakings, sustainability reporting should provide decision-useful information for investors and stakeholders, support effective risk management, and facilitate the allocation of capital towards sustainable activities. Last year, the Commission significantly streamlined the Taxonomy Environmental and Climate Delegated Acts by removing almost 70% of the data points from the reporting template, thereby reducing reporting burden substantially while preserving the information relevant for the users of the annual reports. With the changes to the Corporate Sustainability Reporting Directive, the number of companies to report under the taxonomy has also been significantly reduced. The review of the Taxonomy Disclosures Delegated Act is the final building block in the simplification of the sustainability disclosure rules. Now, to address the points raised in the Commission's call for advice, in the consultation paper that we published on the 1st of July, we are proposing improvements for insurance disclosure requirements with a clear objective to ensure that the taxonomy disclosure rules create value. Our draft proposals aim to increase transparency, simplify reporting, and better align insurance taxonomy-related reporting requirements with other sustainable finance frameworks, as well as with requirements applicable to credit institutions. To sum up in a nutshell, the consultation paper suggests refinements to the existing underwriting KPI so that it better reflects insurers' contribution to climate adaptation by focusing on the lines of business that are actually covered by the taxonomy framework. Explores the advantages and disadvantages associated with the introduction of a new KPI on green insured activities. While this could increase reporting burden, it would better measure the wider enabling role of insurers by providing greater transparency on the share of insurance business supporting taxonomy-aligned activities and further enhance consistency with banking disclosure. Third, it proposes simplifications to the reporting framework by removing disclosures that have proven to be of limited value, by streamlining reporting at group level and marking taxonomy information more visible within insurance annual reports. Overall, these changes seek to improve the quality and usefulness of disclosures while reducing complexity and administrative burden. I would like to clarify that the changes do not cover other aspects of the taxonomy regulation, so as the technical screening criteria, as this is beyond the scope of this advice. As Carlos already highlighted this morning, you have the opportunity to hear an overview of the proposals and to discuss them with our team. I would really encourage you to do so. I think this is an excellent opportunity. The team will present EIOPA's proposed revisions to the insurance disclosure requirements and will be happy to, of course, answer all the questions either directly or come back when there needs to be a little bit more. When you're asking questions that we are not immediately have the answers to, but so let's challenge each other a little bit. Let's try to use the opportunity this morning to really dig deeper, try to have a better understanding at the end of the event, and have a better and clearer picture of the direction that we intend to take this work. So it's not about per se collecting feedback to the consultation as such, and it does not replace the participation in the formal consultation, but I do believe it's an excellent opportunity for all of us to exchange our thoughts and our views. So I wish you a very fruitful and informative morning. Thank you very much.
Thank you, Patrick. Thank you so much for those words, which really set the scene for today's, for this morning session. So without taking any more time, I would now introduce the first session, as I mentioned, where we'll be touching on the proposals that are included in the consultation paper concerning the underwriting KPI, the combined KPI, and some other targeted simplifications. For the presentation in this session, we will have three colleagues from EIOPA presenting. We will have Ursula Bordas, who is a senior sustainability expert at EIOPA. Then we have also Sergio Delgado Coelho, who is an expert, a sustainability expert at EIOPA. And we will have also my colleague Alessandro Molinari, who is a consumer protection expert here also at EIOPA. So with that, I would have the pleasure to hand the floor to Sergio, who will start with the presentation. The floor is yours, Sergio.
Many thanks, Carlos. In this part of the presentation, we would like to start with an analysis of insurance disclosures. So as you can see in this first slide, we analyze a sample of 2024 annual reports of non-life insurance, reinsurance undertakings with the highest gross written premiums under Solvency II, basically to identify methodological changes and data limitations affecting the KPI. Our sample comprised of 15 insurance undertakings for the underwriting KPI and 16 undertakings for the investment KPI. And this analysis does not cover the combined insurer KPI. In figure 1, we can observe that on average, taxonomy aligned underwriting activities represent a very small share of the total premiums covered by the KPI, approximately 3%. On taxonomy eligible but not aligned activities, it accounts as well for a relatively small share, around 17%, while taxonomy non-eligible activities represent the largest proportion of the premiums, approximately 80%. On figure 2, alignment and eligibility per company, we can observe that for taxonomy aligned, most undertakings fall within a low alignment of ranges, and for taxonomy non-eligible, most undertakings fall within higher ranges consistently. And here we can identify a significant divergence for taxonomy eligible but not aligned. So you can observe here in the first part some German companies with a high level of taxonomy eligible or not aligned, and then other companies in other jurisdictions with a low level. And based on the sample analysis, companies in Germany and Austria exhibit taxonomy eligible ratios as set between 50 and 30%, respectively, while the remaining jurisdictions remain very low. And this can be related to a divergence in methodological approaches related to the inclusion of whole line of business when a product covers specific natural catastrophes, or versus only including relevant contracts covering such risks within the eligible line of business. And as well, the application or not of the split of premiums in the numerator of the KPI. And here, many undertakings that we analyze identify or we recognize through their annual reports main challenges on the methodology and data limitations. For instance, they face quite a lot of significant challenges on the do not significantly harm and minimum safe words framework, as well as on interpreting or applying the technical screening criteria for specific sectors. So on the next slide. So for the combined insurance KPI and the writing and investment KPIs, only around 50% of insurance undertakings comply with the interpretation of the commission of this weighted average of the two KPIs, and remaining insurance undertakings do not disclose it, arguing that such ratio is not meaningful, as it would be a combination of assets and liability, and this makes difficult the interpretation of it. And with that, I give the floor to my colleague Alessandro for the next slide. Thanks.
Many thanks, Sergio, for the floor. In this slide, we wanted to complement a bit what Sergio mentioned. So not only we looked at annual reports, but also we looked at the data that we have available in our Solvency II templates. So in this slide, we try to answer the question: how much are insurers already providing allowance for risk prevention measures in their products? And before I go into the results and into the answer to this question, since we're here, we're talking about Solvency II data, it's important also to highlight the data limitation, because here there are basically two aspects that it's worth highlighting. The first one being that we looked at Solvency II S14 template, and we looked at one particular subsegment of the fire and damage line of business. In the S14 template, indeed, there is one subcategory of natural catastrophe products, and we found it useful to look as precisely at that one. And second of all, the presence of this design feature, which are risk prevention measure, do not, of course, are not the same one as the technical screening criteria. The products in this data point do not satisfy all the criteria for the technical screening. However, it gives us a good indication and a good data also to compare with the 3% that Sergio previously mentioned. So as you can see in the graph in the right side of the slide, we notice that the majority of underwriting undertakings do not actually embed this product feature in their products. And let me clarify that in the template, we ask if the product makes an allowance for risk prevention measures, and these risk prevention measures can be financial incentives for the policyholders to mitigate the underlying risk, such as rebates on premiums, lower deductibles, or tailored risk expertise provided by the insurers to advise the policyholders on risk mitigation measures. So at the current moment, you can see that 52% of the undertakings do not embed this feature in their products, while 37% of undertakings do it. And by looking at the also data from 2025, we noticed that the trend is fairly stable, meaning that in our view, there is also room to increase this risk prevention product design feature, and so that it's more comparable, let's say, to the underwriting KPI, which is subject to the public consultation. Now we have presented, Sergio and I, this data analysis, our data findings. So I now give the floor to Ursula to present what are we actually proposing in the public consultation.
Thanks a lot, Alessandro. And indeed, let's now look at the proposals. You will have seen in the consultation paper, in particular on how to fix the underwriting KPI. We are proposing two things. First of all, how to make it more accurate. So the underwriting KPI, the name, is quite broad, right? It indicates taxonomy alignment on the whole underwriting, while actually what is covered is, as it was explained before by Sergio, by Alessandro, the adaptation. I mean, there are no other activities in the taxonomy at the moment for insurers that are recognized on climate mitigation or on other environmental objectives of the taxonomy. And therefore, we are suggesting to improve this substantiation of the name by precisely adding adaptation to it. So adaptation underwriting KPI will be much more suitable to make this disclosure more meaningful. It's clear this is just about adaptation. That also opens the door to cover in the future other activities. This is beyond our mandate at EIOPA, but the taxonomy, after all, will be reviewed, the technical screening criteria. This is happening now, and it will probably as well in the future, as this is a delegated act that can be reviewed every couple of years. So this change is a small change, but with a lot of impact. And now let's look into the ratios as such. So we have two ratios on alignment, taxonomy alignment, and taxonomy eligibility, like all the other companies that are disclosing under the Taxonomy Disclosures Act that are actually non-financial. This is important, and we will come back to this in the next session. This is not a look-through approach. We are in the insurance having the only activity in this sector, in financial sector, that is recognized as environmentally sustainable, and these adaptation activities are listed. So we have alignment and eligibility ratios. What are we suggesting to do? We are suggesting to keep the numerator as it is. So have the split of premiums requiring only to cover the premium that is for responsible for this NatCat risk coverage for the alignment, and that passes the technical screening criteria. We have heard a lot of criticism about this specific approach, but we have also looked at other sectors and did not find products where the whole product, the whole revenue is allocated. It's quite specific, the taxonomy, to an activity. Therefore, we are suggesting to keep it. In addition, we're also seeing that despite this criticism, companies are reporting on this. And additionally, as well, Alessandro was mentioning, similar information, also on NatCat risks, is reported per lines of business under the Solvency II. This is not completely the same, but we see that such information, such reporting in values is possible. And now let's speak about the denominator. At the moment, the denominator is very broad. We have all non-life business included in it, and some of it is not even eligible. We are suggesting to limit this to the 8 eligible lines of business, because this is as well the approach for the other financial KPIs, although those are following another approach, the look-through approach. So if the denominator is shrink to 8 eligible lines of business, we see already this would be more meaningful. We are focusing only on those activities that potentially could be also making it to the numerator, could be taxonomy aligned. As such, this will lead to an increase of the final figures reported. And I mean, Sergio was now looking at and showing you the data. So for sure, we see this eligibility being decreased here, right? So what is eligible, and therefore the final figure will go up. Now let's move into the eligibility ratio, because that is precisely where as well there is some fixing to be done. As showed by the data by my colleague, that there is a lot of different practices, and this most likely results from some clarifications and from the legal text being interpreted in different ways. In particular, we have observed all these practices on whether the whole line of business should be included as eligible as soon as there is one contract in this line of business that is actually eligible. Well, our answer is no. It should be only in the numerator, including only those contracts from the 8 eligible lines of business that actually cover NatCat perils. And within this, we should also have only the split of premium, so have only the part of the premium that is allocated for these NatCat contracts. For this NatCat peril. In a way, this is then similar as for the numerator of the alignment ratio, and therefore it's easier to track an increase between eligibility and alignment, and so this potential for improvement as well. For the denominator, the same as for the alignment, we are suggesting to have 8 eligible lines of business. Let me mention that we have as well had many discussions with different stakeholders on the denominator, and there was also suggestions that probably will come up during the consultation on alternatives to the denominator, and we are very happy to hear such suggestions. We have examined whether the eligibility could be, so the lines of business in the denominator shrink to the most relevant, 3 or 4, in particular focusing on property and transport. Nonetheless, as the technical screening criteria, so the environmental delegated act is broader, these 8 lines of business are inscribed in there, and we cannot go against that. So a change of these eligible lines of business would require changes to these other delegated acts that are, as said, beyond from today's consultation paper. Next slide, please. And now the combined KPI. This is the KPI that is required, so the disclosure for insurance to have one figure of insurance taxonomy alignment, and it's a combination of the 2 KPIs, because in addition to underwriting, we have as well the investment look-through KPI. We have heard as well here and collected some views on the usefulness and also in particular reported data. We have not seen many companies reporting this, and that is because it's a mix of apples and pears, assets and liabilities, and therefore it's not seen as very meaningful or useful as average combined KPI. So we have thought about this and indeed agreed that perhaps it would be better not to have such a weighted average, because the 2 KPIs are meaningful, but put together, it's a mix that is not so meaningful. What are we suggesting is to have them separately. And then, of course, there are situations when one KPI is needed. These are the financial product disclosures under SFDR, which still have as criteria taxonomy, but also insurers' investment KPI. So when investments are made in other insurance companies, and the same happens for asset managers. So for funds investing in insurance companies, and will also be needed for group reporting. So in these cases, we suggest to take the KPI that represents the main activity in terms of revenue. This is only relevant for composites, of course, because for non-life insurers without life investments, that would be only the underwriting, and for life, only the investment KPI. So these are the core proposals here on the this part on the underwriting KPI. And now my colleague Alessandro will present you the other changes. Alessandro, over to you.
Indeed, thanks, Ursula. Here in the next 2 slides, we want to propose 2 additional simplification. In addition to what Ursula said, we also asked ourselves, how can we make this disclosure more useful, also considering our guiding principle of burden reduction and simplification. And the first simplification that we are proposing in our public consultation paper is the removal of the gas and nuclear breakdown from the identification in the investment and underwriting reporting templates. Why are we proposing this? There are 2 main reasons. First one is related to the underwriting template, and the second one to the investment. With regard to the underwriting, we simply noticed that the technical screening criteria for insurance and reinsurance activities for gas and nuclear sectors do not apply. So when we looked at annual reports, we found out that this template was mostly not used by undertakings. On the other side, on the investment side, the exposure to these sectors by insurance and reinsurance undertakings are typically not material. So this removal also aligns with the materiality approach, which is the 10% threshold that was introduced in the 2026 Omnibus Delegated Act. What do we expect from this? We expect a reduced administrative burden, and we expect that insurance and reinsurance would actually save some cost in not reporting on this breakdown. In the next slide, we see the second simplification that we are proposing. In the next slide, we will see what we are proposing with regard to the executive summary. Exactly, which basically entails that our proposed changes is to introduce a standardized dashboard at the beginning of the section. Why? Because we have noticed that these key indicators, which might be very useful for some users, not only institutional investors, but also other players, consumers, etc. This data is often quite hard to find in the annual reports. So we're proposing the introduction of an integrated sustainability executive summary to house key information regarding the taxonomy, but not only. Also, the information concerning the European Sustainability Reporting Standard indicators. Why we are proposing this? Because, as I said before, despite the high reporting costs, users currently make limited use of this disclosure. And also, when we looked ourselves on this report, we found that these key taxonomy figures were often buried within complex and lengthy reports. In terms of the expected benefits, we found two main expected benefits. The first one being the usefulness of the report being improved and increased visibility. As I said before, we think that such a dashboard would put forward at the beginning of the sustainability section key information for users that are mostly that can be used by them, and this proposal ensures that critical green metrics would make sure will allow users to also compare between different undertakings. So in a nutshell, these two other simplification, which are described in detail in chapter 5 of our public consultation, we believe are fully in line with our guiding principle of simplification, burden reduction, but also to increase the decision and usefulness of the reports. So the first session is now over. We have some time for Q&A. So we are happy to reply to the question. Feel free, as Carlos mentioned in the beginning, to use the Q&A function in Microsoft Teams. And so we will give also some time for you to think about possible question to put in the chat.
Thanks a lot, Alessandro, and thanks for all the questions coming in. We will be publishing each question that we are answering, and so that you can track actually what question is being answered. So we have a question asking about the denominator, about the 8 lines of business, that we are the main reason for sticking with the eligible 8 lines of business for the suggested simplified underwriting KPI is simply due to not being able to change the technical screening criteria. Is an amendment to the technical screening criteria really impossible in course of the taxonomy revision? Some of the lines of business may in theory cover climate-related perils, but in practice not. This artificially lowers the ratio by incorporating revenues that can never be taxonomy aligned. This is indeed part of the technical screening criteria of this environmental delegated act, in which EIOPA is not mandated to provide advice. Therefore, it's out of our scope to make their changes or to suggest changes. And our understanding is that there are some, at the moment, revisions to the taxonomy. They are focused. There is a platform of the Commission working on this, and this is up to the Commission to then also revise those or other areas, other economic activities and their technical screening criteria. And of course, as a delegated act can be each 3 years or so revised. So I think that the purpose or our understanding of the taxonomy is that there is a moving tool measuring the sustainability as the economy grows and develops. So any changes can be done, but as said, this is beyond this technical, advice. So this advice is only on the disclosures, and we can therefore only make these suggestions. Okay, we'll probably be jumping through topics. We have here another question about the executive summary on whether this is including ESRS data and whether this goes beyond the advice requested from the Commission. The request was about disclosures, insurance disclosures, and insurance disclosures are in the annual report. We have looked at many annual reports from insurance undertakings and found that these taxonomy disclosures are quite hidden. They are difficult to find. They are somewhere sometimes after E1 from ESRS, sometimes after all environmental disclosures, sometimes after all ESRS disclosures, making it very also difficult to find them and compare across insurance undertakings annual report. And in general, there is a lot of data, right? We also see that there are links between ESRS and taxonomy, and therefore it would be good to have an improvement in the disclosure. So in the form, we have touched upon, for example, the name of the underwriting KPI. So having information about the taxonomy disclosure, so the key KPIs and not the full template in a dashboard would be very useful. And that, of course, has to be improved with the consistency with the ESRS because these data are so much related. I think the only challenge for us is the timing because of the Omnibus Directive having already made changes to the annual report in terms of the ESRS, and therefore, this might be maybe more difficult to implement, but that's up to more the legal colleagues in the Commission to see if this disclosure delegated act can introduce dashboard. We have another question on good practices. Will you publish what good looks like guidance on these new changes? EIOPA can always provide best practices reports and examples. For the advice as such, we could explore some examples if that could be helpful, for sure. But this is not a report that looks into best practices or guidance, right? This is an advice for the legal changes to the disclosures delegated act. So within this, of course, such a delegated act have no examples. So that can be done in particular, I think more in the future, if that would be useful for stakeholders.
maybe Ursula, while we wait for the other questions coming, I think there was one participant that suggested a useful underwriting KPI for climate adaptation. The participants suggested the number of actual and documented prevention measures for the insured object with a high risk profile for a specific climate change related event, like extreme rainfall, flood, heat, drought, and wildfire. And the participant mentioned that this KPI could encourage the adaptation measure for insured risk with a high risk profile. And my view is that, of course, it's an interesting proposal. Of course, there are some consequences if we would propose this, but we would encourage you to also submit this via the public consultation. And if you could elaborate this in there would be for sure useful. And I think it's a good time to remind all that the public consultation is open until the 12th of August. I don't know, Ursula, if you want to add something on this, but for sure we welcome this kind of comments on the way by which the underwriting KPI could be improved.
Yes, very good. Thanks, Alessandro.
So if I may, on the question related whether we have insights in the results per technical screening criteria. So in general terms, when we were analyzing the annual reports, many of the take-ins just mention the complexity of the technical screening criteria and the difficulties related to relying on third-party data and as well on the complexity of the minimum safe words and do not significantly harm due to this dependence on data. Thank you.
Thanks a lot. We have another question, which is very technically difficult and relevant. Investors need turnover and CapEx KPIs from their investee. So we're looking now at investors' perspective. How would an investor in an insurance company use the underwriting KPI in this light, as turnover KPI, as CapEx KPI, or as both? Following your proposal, the underwriting KPI might be the only available KPI. Yes, this is a difficulty of the different approaches, right? So for other companies, we have turnover, CapEx, and voluntary OPEX currently as metrics being used. The underwriting KPI doesn't work that way, right? So we have gross written premiums being reported, and this is the closest would be to turnover. At the moment, of course, we already have a weighted average. There is a mix of investments and the liabilities, so the underwriting and investment. So I think the difficulty that you are mentioning is already in there, right? How this KPI combined is being treated. Maybe that would be my first kind of answer as question to reflect on this and to see what would be the best way. But these type of comments are very useful because we have not, for example, addressed this specifically, and would be a good reflection to how to link this underwriting KPI to the investments in, so the investment KPI or the green investments ratio. But as such, I think would be turnover for sure, not CapEx and not OPEX. Okay, one more question, this time about the denominator. Did you investigate whether if the denominator were narrowed by excluding certain lines of business, the resulting alignment ratios would go up and be better comparable to those reported by other financial institutions? Or is there still a big gap making comparability difficult? So first point is that for the other financial sectors, so for the GAR and for the green investment ratio. The denominator includes only eligible at the moment, right? With the last year delegated act activities or look through, right? The exposure, because it's not directly. So in a way, we have already a limitation that these two KPIs are different. They are following different approaches, being included in the taxonomy or being a look through exposure to other activities that are taxonomy aligned. With regards, therefore, to this eligibility, what we have improved is to look in the denominator indeed to the eligibility. We have considered narrowing it down to the core eligible activities, but doing so would bring in conflict the Disclosures Delegated Act with the Environmental Delegated Act, because at the moment, the eligible lines of business are broader. We see that there is a focus, in particular, set in property and transport-related lines of business, which are 3 or 4 lines of business instead of 8, definitely. On the other hand, the taxonomy is supposed as well to incentivize more NatCat risk coverage across lines of business. So restricting the denominator to a lower number, or the core, currently would go against innovation or this incentivization of having broader, more products in other lines of business. That's one thing. And the other thing is about as well comparability. So exactly, if there would be companies with activities beyond this core lines of business, they would not be able to be disclosed if there would be flexibility about this. So that was another option we explored, where the companies could define its own denominator. But here we saw that this would go against comparability. So having companies disclosing against the 8 or having eligibility observed in more lines of business and comparing companies with a more restricted eligibility, so limited lines of business, would not allow to compare across companies. And this is, of course, one of the objectives of measuring taxonomy alignment. Therefore, these principles and these objectives led us to make these proposals. But as I said, we are very happy to hear alternatives. And I think there is a question specifically about this in the consultation paper. So at the moment, we have no more questions coming in. Is there any other question that you would like to ask about this adaptation underwriting KPI, the numerator, the denominator? Is there any question about the eligibility ratio, for example, observed practices, or about the Solvency II NatCat disclosures, so reporting? If not, Carlos, I think I will pass over to you.
Indeed. Thank you so much, Ursula, given that indeed we don't see any more questions coming in. We are a bit ahead of schedule, but I would suggest that we would break now for a short coffee break, as we had planned in the schedule. And we could, let's say, come back. Actually, yeah, there's someone who posted that there are some questions at the bottom. So I don't know, Ursula, if this is if there's any new question, or if these are only, let's say, comments to the first question that was published. There are indeed some follow-up comments. I don't know if you want to have a look into that.
I see that indeed. So I think there are some questions that are being asked as comments to the published questions. Sorry for that. We didn't look at at that. So please submit questions as new questions, so we see them coming in our internal tool. So Romano Massimo, you're asking, linked with the previous question, which related to the 8 lines of business in the denominator. Do you consider the alternative to use mandatory at the denominator, the 3 main lines of business, and voluntary to add the other 5 lines of business if the company considers them relevant? So such a suggestion would bring core comparability with the 3 main, or 3 or 4 actually. I think we've heard as well some suggestions on 4 lines of business within a more core KPI. And voluntary would mean adding the ones that are less relevant, or there is less activity identified in these lines of business. I think we could consider such alternatives always. The main issue is, at the end of the day, we need one KPI, right? So we would have different KPIs, one the mandatory and one voluntary and additional. The question is, what is then being used when one KPI is needed? So we always have to think about how the taxonomy disclosures in the annual report are useful for other disclosures, for financial products, for investments, and so on. So such a suggestion, I think, would bring a bit of complexity to that. We have as well considered having only one KPI that is actually aligned versus really eligible activities within, so the alignment ratio to the eligibility ratio, to see the potential. But as said, this is very specific than additional KPI. And we're also looking at simplifying and not adding too many KPIs. So I think such a suggestion could bring complexity, and that should be then taken into account whether it's a more useful disclosure or rather brings complexity. But very happy to hear that in the consultation answers to get more information. Then we have a reaction from Flavia Misilota to the same question, but actually referring to the dashboard. And I think that one we have already published. So will the proposal of dashboard executive summary be cross-referenced or sync point in the revised ESRS? We have not went so far to that level of granularity, Flavia, but definitely this would be a good objective to have cross-referencing, to be able to use the annual report and find information, and have it more combined, so more integrated ESRS with the taxonomy information. And such also proposals would be very, very helpful for our advice. You might have seen this section is actually quite short in our consultation paper. So bringing ideas, how to make this dashboard connected to the rest and how to interconnect information are very much welcomed. Okay, then further comments, this time from Giovanni Campana. Please note that the 8 lines of business are not eligible LOPs, but the scope where insurers can have eligible gross written premiums, climate insurance. The proposal to limit the denominator does not require to amend the directive, the delegated act, only to limit the denominator to the lines of business where the eligible products actually are. Exactly. So our proposal is based on the current framework, taxonomy framework, which is composed of the different delegated act and the regulation as such. So based on that, the proposal is to exactly work together with what is already required in the environmental delegated act, these 8 eligible lines of business. And within this, we are restricted. Should that be changed, the environmental delegated act, then of course the disclosures would also be changed accordingly. But that is something that is not at the moment possible. So we will need to first, have those changes to then disclosures follow at the end of them, right? Okay, I think there is still one comment here in this exchange on the executive summary again, on whether the proposed dashboard provide an accurate and transparent representation of the company when the detailed disclosures relating to fossil and nuclear gas has been removed. So I don't know, Alessandro, if you want to take this question.
Yes, indeed, Ursula, that's a good comment, but I would also reply that our unified dashboard that we propose is not aiming at having a fully accurate and precise representation of the company environmental performance. Our simplification was more grounded in trying to make the existing reporting templates and the proposed changes more upfront. Of course, as Ursula explained, there are also connections with the ESRS, and I see the point of this question, but I think the objectives are a bit different in the sense that here we are trying to make what we have more upfront and more simple for users to use. But we are not, let's say, that ambitious to say that this dashboard would be a fully and detailed actual representation of the performance of a company. Here we are more talking about the role of the insurance company for what regards the climate transition, climate adaptation. So I think the scope are a bit different, but I thank you for the comment.
Okay, yes, thanks a lot, Alessandro. We have more questions now coming in. So we have again a question about the denominator. How about having one single KPI where the denominator is based mandatory by the 3 core lines of business and then the voluntary for other? In the investment ratio, there is already this approach where company can voluntarily add investments in specific conditions. We would look into this from the investment perspective on the voluntary disclosures and look whether this can be somehow explored. So really happy to see more detailed proposals about this. We'll have to consider pros and cons set and the whole framework. Perhaps one comment still on the fossil gas and nuclear. This was, of course, a disclosure that was added to all disclosures because of the political decision to include such activities in the taxonomy. But looking at the data, we do not see that these disclosures are for the investment KPI material. They are really below 1%. So how material this is, not so much. So how relevant is to include it in the templates? It's perhaps an information that could be in the narrative text when relevant, or they could be included when material. Perhaps that would be a better way to go for it than having, you know, a big template with a row that is actually not providing decision useful information because of the low materiality. And of course, for the underwriting KPI, this is not relevant at all. So this is the proposal, but alternatives are set and views on this are being collected. So do think about it. What is your preference? Okay, we have one more question which relates to what Alessandro was explaining on the Solvency II reporting framework, which does report gross written premiums for products containing coverage for NatCat and climate-related perils. Wouldn't it be a way to reduce complexity simply to use the same, that reporting for the calculation of the underwriting KPI, and if Europa maintains the artificial split of premium by separating the bit that relates to climate perils, why do you point to Solvency II as an argument for maintaining split of premiums? Publishing this question. So this is data exploration we have done from Solvency II, which looks at the indeed gross written premiums and related to climate perils, but it's slightly different. We have looked at it to identify that such data is being collected. It's not the same as the taxonomy. Of course, the technical screening criteria and so on are much more detailed in the taxonomy, but it goes in the same direction to identify which products contain preventive measures for specific lines of business and covering climate perils. The templates, however, are conducted sometimes in a yes or no answer. So there is a yes or no indication on these preventive measures. So it's slightly different. The purpose is also different. And yeah, again, we are not changing the Environmental Delegated Act, only the disclosures. As such, of course, consistency would be always welcome to have consistent data reported across frameworks, so across Solvency II reporting templates and these disclosures and so on. We are definitely supportive of that. If you have ideas on how to improve those and where to go, in which direction, the templates are also available from Solvency II online. Nonetheless, we have here incorporated this in particular to identify whether data covering these risks in products is reported separately. So whether there is quantification of the product's risk coverage already available and being reported. It's not exactly as the split of premium, but very close to that. So that's why we use this argument here.
Yeah, so Ursula, so thank you so much for that. I think it was very good. Thank you also, of course, to all the participants for all the questions, some quite challenging, as the colleagues mentioned. So we'll also give us some food for thought as we work towards the finalization of the work after, of course, the public consultation. So we thank you, of course, for this initial feedback. As mentioned, this, of course, does not replace your participation in the public consultation, but we appreciate the points that were made, and we'll start, of course, also thinking already about some of the points that were made where maybe we can still improve and refine also the advice that we will be providing to the European Commission by the end of October. So with that, thank you to also the colleagues for the presentations and for all the lively questions that were posted. I think we managed to cover all of the questions that we received, which was also good. And with this, I would suggest that we break for coffee. We had planned a 15-minute coffee break, but given that we are 5 minutes early, just to keep a bit the schedule also for colleagues who may be joining us specifically later for session 2, I would suggest that we do a 20-minute coffee break and we resume at 10:30 as planned with, I would say, maybe one of the most interesting topics, which is, of course, this discussion about the pros and cons, the challenges, but also eventually the advantages of considering the introduction of a KPI focusing on the green insured activities by insurers and reinsurers. So thank you so much for your participation so far. Stay tuned and we resume back at 10:30 sharp with this session. Thank you so much. Okay, so thank you so much. I hope you had a good break and had the opportunity to take some coffee and think and prepare a bit for the topic that we are bringing to you next, which I think it's also quite interesting. And as I mentioned just before the break, this was, of course, one of the core elements of the call for advice that we received from the European Commission in relation to the insurance sector. So as you may have already seen in the public consultation, this is a topic where EIOPA is exploring pros and cons, not coming at this moment with strong proposals on this green insured activities KPI. And this is indeed this event today, together with the public consultation that we have ongoing, is of course an opportunity for all of you to provide us your views and share your feedback on this specific topic. So to guide us a bit through the proposals and the ideas that we have included in the consultation, I'm happy to invite again my colleague Ursula to the floor, who will introduce some of the concepts to you. And then, of course, as in the previous session, we will have the opportunity to take questions on this topic from your side. So Ursula, the floor is yours for this topic.
Thanks a lot, Carlos. And indeed, this is was very specifically requested by the Commission to provide advice on this. So we are exploring indeed pros and cons, and also whether such a KPI should be rather voluntary or in the long term. EIOPA in this consultation paper is not saying this is a new KPI that should be introduced next year. That is for sure, and that is mandatory. And that is because we see that there is already a lot of reporting, right, on taxonomy, and we have to balance as well all the new amount that companies have been producing and are now producing in the last year since the taxonomy disclosures are mandatory. So rather in the long term or voluntary. So no strong recommendation. Nonetheless, we need to have this in the advice, and actually stakeholders' input will be very useful to guide us as well and collect issues that perhaps even are not addressed here, such as, data collection to do that and so on. But first of all, what is it? So we have the underwriting KPI, which is these adaptation activities that are included already in the taxonomy recognized as environmentally sustainable. This KPI would look at underwriting, but only for the insured activities that are taxonomy aligned. So it would look at activities and objects of companies. So any type of insurance given to a company would be collected and aggregated. We will see what is the commercial alignment of taxonomy. Why? Because this, of course, provides a positive disclosure on what percentage of insurance goes to green activities and is enabling these activities. So similarly as the GAR, for instance, right, with the financing, it would look at this enabling role of insurance, of non-life insurance, to allow companies to operate. Without insurance, there is no activity possible very often. And some activities are actually quite risky. So having insured green activities where the risk is very high is actually very positive contribution. Then separately as well, we have the retail, and here we can only explore there where the objects, activities are already in the as well technical screening criteria. They are recognized in the taxonomy. And so we focus in transport and property. If we move to the next slides, we can here see what we are exploring. So the benefits, limitations, and costs. Asset benefits would be strong alignment with the rest of the financial sector, right? No banking, no asset management KPIs are related to activities in the taxonomy. This sector otherwise is not recognized as sustainable in the taxonomy, but it is through a look-through, through the exposure, through the financing, so investment, enabling companies to get financed, be it by mortgages or be it directly by equity or corporate bonds. So a look-through ratio here would have improved this consistency, and as said, would also allow to see the whole picture, which we see as well that under other disclosures in the annual report, in particular related to CSRD, where we have risks, opportunities, and impacts. These disclosures often on impacts as well include this information. What percentage of policies is actually related to green activities in short? And therefore, consistency would also improve within the annual report as such. Limitations, many, of course. First of all, there are not so many companies in the CSRD, so disclosing the taxonomy, so limited scope of companies that would be included in this KPI as well. Then more specifically, I think there are some limitations, for example, for the property, right? So the taxonomy only using the European, so this EPC, the certificate for property on energy, this is only focused on retail activities, retail buildings. And so, for example, for the commercial, there is difficulty to cover the building in short that are green. So there are some limitations that come as well from the narrow scope in the taxonomy as such, then on the scope of the reporting, so CSRD impacting the companies that report on the taxonomy, and therefore this KPI would only be able to cover this part. This is also the case for the GAR, where in the denominator it is as well excluded, so we are following the same approach. So only eligible activities or those that report on the taxonomy. But there is also another limitation, which is on the data collection, how to identify which activities are covered, which objects have taxonomy data, who collects this data, how this data is processed internally, and then reported. That will need to be a new, of course, reporting chain, and probably as well involve advisors and brokers. So at this point of time, we see, of course, that we have already few years of taxonomy reporting and all the processes are being implemented. And certainly this would add complexity, but also costs. That's why we're looking at these costs and benefits. But now let's move to the next slide where we actually look at the methodology. So how could such a KPI look like? How to collect this data? Possibly similarly as with the GAR, it's not just one KPI. It's actually a combination of different. We try to approach this through a set companies, so the commercial KPI, and then on retail. For the commercial sub KPI, we would look at total aligned activities in the numerator and a set total eligible. So only there where companies actually report taxonomy, are in the scope or do that voluntarily, this information would be in the denominator, and the same for alignment. So the underwriting gross written premiums related to these companies. And then for the numerator, the gross written premiums for these policies that are for commercial companies would be multiplied by the share of taxonomy alignment of the company. And all of these aggregated would bring us to the commercial part. But as said, there are some limitations. So this would be covered by all the lines of business. So identifying all type of activities in short to accompany would be aggregated here. So total gross written premiums for insured specific company and then aggregated. The limitations, as said, well, there are some activities that are not covered, are not included, or as said, for example, property, which is an important line of business, for commercial real estate is not included, right, in the taxonomy. We would as well have retail then sub-KPI, which would focus on transport. Here we have cars, bicycles, planes, and heavy trucks. And then as well residential property, which is much better covered in the taxonomy, but also comparability is a bit limited because this EPC is implemented differently across countries. So these are limitations that are beyond the disclosure. So we're using what we can and is already in there. So what would be the total KPI? That would be the combination of both. And I forgot to mention that for the commercial one, we're actually suggesting to be able to use two KPIs, turnover-based and CapEx-based, just as for other KPIs. But for the total one, the turnover one should be used. So added the commercial to the retail, turnover, commercial and retail, would in the numerator bring us with the total eligible green gross written premiums in the denominator to the total KPI. So this is the methodology. It is, of course, not complete a set because of limitations that are beyond us. We also happy to hear views about improvements to the methodology. We're also happy to hear views in the consultation about the usefulness of adding this, whether it should be voluntary in the long term or not at all. We have different objectives and principles important, so consistency versus cost reduction, and therefore at the moment it's exploration pros and cons as said. And then also final point I think to mention is that there are different views. So far we have collected some views through the platform of the Commission and so on. So we hear that some are very supportive stakeholders and some are less supportive, and all of this we would really want to explore further in your answers. So with that, I close my presentation, and we are very happy to see questions and discuss with you a bit, or see the areas that are of your interest, where you have maybe some questions on our proposals or would like already to share some views in the questions. Okay, fantastic. We have already a few questions coming in to break the ice. So for the commercial here, an insurance undertaking should consider only its CSRD counterparties and only those for which the undertaking has underwritten policies in the lines of business eligible for the taxonomy. Is that correct? And now this is published. So with the first sub-question, yes, it should consider only the companies that disclose on the taxonomy. These are those that are now in scope of the CSRD, but the taxonomy can only, and the CSRD can be applied voluntarily. So these voluntary disclosures can and should be as well included when identified. With regards to the second sub-question, So this is not related to the underwriting lines of business. We are no longer here looking at all at adaptation, right? So for the adaptation KPI, the adaptation underwriting KPI, this is established what is eligible in there. That's not the case here. This is not related to adaptation. It's related to all taxonomy objectives, climate mitigation, pollution, and so on. For the insured activities. The companies are already disclosing these shares. They have to follow their own technical screening criteria, and therefore the insurer would use this information and multiply it by the gross written premiums that are for policies for that company in all lines of business possible. So there is no restriction. We do not see any need to exclude a specific line of business, also policies in a specific area. So this is additive in a way, aggregated to not as weighted average, but additive, right? So all total gross written premiums. So the more policies that are being sold to a company would be included in the numerator. Okay, are there any other questions about this important part of the consultation? Okay, another question coming in. Do I understand correctly that this KPI would primarily reflect the taxonomy alignment of insured counterparties or assets rather than insurers' own sustainability performance or contribution to the transition? So, tricky question because it has different aspects. First of all, the first part, yes, this KPI reflects the taxonomy alignment of the counterparties. It's a look-through exposure KPI, just as it is the GAR or the investment KPI as well, right? Which uses only assets under management and then the taxonomy of the investee companies. Same here, gross written premiums and taxonomy of the insured activities. That's why we tried as well with the name, find a good name that focuses on this, does not give an impression that this is about other activities of insurers, so additional to adaptation as such, where there is, you know, a specific incentive that for policyholders to improve and so on, that would make it green as policy, but rather exposure. So it's the look-through. With regards to the second part of the question, nonetheless, so whether this is a contribution to the transition and the question of this, questioning of this contribution, this is a bit more tricky. I think we have seen in public discussions and in annual reports different disclosures about this, whether insurers have a positive contribution to the transition by insuring the green, so insuring green activities, or by non-insuring fossil fuels, so brown activities. What is the role of this? There was the, you know, other also initiatives such as the Net Zero Alliance, which precisely on underwriting was looking at these green insured activities as contribution to the transition and impactful. For sure, we see that in particular projects where the risk is very high and it's difficult to seek insurance, ensuring such activities has a very strong contribution to the transition, because these activities are very much needed, right? On the other hand, each activity needs an insurance, and so having the insurance is important. So each green activity that receives an insurance that is covered contributes that the insurance to this, enables this activity to function. We are here making it very clear, it's enabling that activity. This is why we are presenting this as enabling role. So also the KPI is strictly focusing on disclosures, right? And therefore we are disclosing transparent way what is the green, the percentage of green insured activities. Okay, we have here another question about the impact of this disclosure on the asset, on the portfolio allocation. So on insured activities, would EIOPA support a steering of the portfolio based on the proposed KPI? Would EIOPA think this is feasible and a reasonable approach? So this KPI provides disclosure, right? Of course, companies might want to have higher numbers and have this objective of improving their KPI and exactly be seen as having a good performance of this KPI. So higher numbers and ensure more the green. This can be impact by some companies. Nonetheless, we do not see that happening actually for the GAR. So when we looked at these disclosures, we did not see that companies, banks increased significantly their disclosures in the last years. They're quite actually small as well based on that. So steering of the portfolio can always be impacted by looking at improving KPIs, but we don't see that happening in banking. So why that would happen here? Another point is also that this is not the purpose, right? So just to clarify that for sure, if that happens, is beyond our control, but it's not the purpose of disclosure. This is just transparency of what is being insured. For us, the priority is that insurers should take a risk perspective, right? So insuring the green is very good, but the most important obligation of insurers is making sure there is enough capital, that they can manage all the risks and so on. The taxonomy is a bit related to that, but it's not following this type of disclosure. This is covered, for example, in disclosures under CSRD on risks, and that is where insurers can disclose how they approach financial materiality, what risks are identified related to sustainability. So sustainability risks coming from physical transition risks for the companies. Taxonomy does not cover that, right? So it's for us very important to make that clear. This is transparency, and the first priority of insurers is actually risk related. It is not to specifically increase their coverage of underwriting activities that are green if this poses a risk that they are not willing to take within their strategy, business strategy. Okay, two more questions here coming in. So first one is the idea of this KPI to discourage insurance coverage of companies that are not yet taxonomy aligned. So this is related to this issue of are fossil fuels should not receive insurance. Should we, exactly incentivize insuring green activities? The taxonomy and the disclosures are measuring these green activities, and here look through to the insured activities as such, but are silent on the brown activities. There is no brown taxonomy, and as such, actually, these figures are more likely to be quite low, in particular, taking into account the reduced scope of companies reporting, as SMEs not being included, asset, commercial, retail, real estate not being included, and so on. So disclosing very low figures, it's going to be difficult to actually have such an impact. Having a disclosure on, brown activities insured could perhaps bring more attention to this discussion. But so it's not directly related to that. It's actually neutral in this sense because it's only focusing on the green, not on the brown. We do not know if we would have here a 2% disclosure, for example, of such a KPI. What is the rest of 98%, right? Is this transition? Is this brown? And so on. It's not covered. But maybe final point, as such a taxonomy by measuring green activities, and here look through, of course, aims at having discussions on how to increase it, how to go into the direction of greening the economy for the whole economy, and including here insurance. So unavoidably, this is an ultimate objective, but it's not as such, covering the brown. So a bit difficult, but investors, when using the annual report, should use this disclosure to exactly identify whether they would like to engage with the company to have more insurance that is green or not. This is potentially a tool for that, but it's not as such indicated as a measurement of it. It's just a transparent figure on what is now being insured that is sustainable. Okay, we have a question from Massimo Romano. How will the long-term approach work in practice? Will its implementation be postponed for 3 years, for example, and then become mandatory or voluntary? Or will there be a further deep dives over the coming years to better understand how it will work in practice? So at this stage, we have left it very open. I think at some point we were considering indeed in 5 years to have it as a recommendation, although usually legal acts go in a 3-year cycle. But a legal act can be always reviewed, just as the CSRD was quite quickly, was not waiting for the obligation to look into it. And therefore, anytime that can happen, if there would be such a recommendation, the Commission would be, it would be up to them to decide when to take this up. And yeah, perhaps looking at as well reactions to the updates now, if the underwriting KPI is being amended, the other reports, so that will need to follow a sequencing, and then a decision whether to make it voluntary or not. Of course, it could be made voluntary straight away now, if that such a decision is supported in, first of all, our advice, and then, of course, in the Commission. Okay, we have now another question, very interesting, on the difference between look-through KPIs, investment KPI for asset managers, but also for insurers, versus this KPI. How does the EIOPA assess the fact that investors in most cases finance the whole investee activities, whereas insurers will take over specified risks that are not automatically covering all of the undertaking activity? Yes, this is a difference of the functioning of financing and insuring, which is beyond us. But the figure of taxonomy alignment of the counterparty, so the investee company and the insured company, is the same. We are looking at that activity from the insurer, so it's the total gross written premiums allocated to all the different insured policies, so everything that the insurer does for this company is covered. And so is the investment, right? So the capital is for the company, how this capital is actually used by the company in a specific year. This is also not very clear, right? So in a way, this can be more demonstrated by the CapEx and turnover KPI in that case, and OpEx, but it's not so direct either. So we are covering the financial activity, so investment and insuring, with the total allocation of gross written premiums and assets under management. So it's mirroring, but of course, as such, the activity and functioning is slightly different. Okay, there is another interesting question, which is posted actually as a comment to a previously published question from Giovanni Campana. How would investors use this KPI? How does it relate with the others when the investee is an insurer? I understand that you are referring this question to the green insured activities KPI. So how investors can use it is a bit related to what we were discussing just before with the questions on it can be used in different ways. First of all, track, monitor whether there is a change. In particular, if you relate this to some type of risks, this can be a useful KPI to look into this. If this is about as well transition to a more green economy, then such a KPI can also look at precisely this aspect. If there is a commitment from a company, and many companies have net zero commitments still for 2050 in general, or even earlier, 2030, such a KPI can actually help tracking achievements of such commitments being disclosed. So within disclosure, it can be used to do that. It can be used to any own KPI of the investor, be it institutional or retail, to actually have own objectives. So with the institutional investor has an objective that the KPI for them should be X%, then it can use this information, right? To as a green performance indicator on underwriting and on impact as well, because after all, this is very much impact related. So the attribution of positive contribution, and so enabling the economy to function, the green economy, is an impact indicator. Okay, I don't know if there has been more discussion on other questions. We would prefer to have questions coming as in directly, please, being posted. And in particular, we're very interested in hearing, yes, views on the usefulness also for investors of such a disclosure, because ultimately all the disclosures in the annual report should actually be decision useful for investors in whatever way they intend to use it. Okay, there are no more questions coming in. So I think it will be over to you, Carlos. Thanks a lot for all the questions asked.
No, thank you. Sorry. Thank you, Ursula. And yeah, maybe we overestimated a bit the time we might need to go through this topic. But we thank, of course, all the participants for the questions that were raised. And as was highlighted by Ursula, we very much look forward to your feedback through the public consultation, through the EU survey, because indeed we will need, of course, to finalize our view for the final advice that we will be providing to the Commission by the end of October. And on this topic in particular, of course, it's there are still some open possibilities that we have considered in the consultation paper that that we look forward to hearing from you about the usability, the burden, but also, in a sense, as Ursula explained, one of the criticisms that is, of course, used frequently on the current KPIs is the fact that it does not really, let's say, address or include the broader contribution of the sector to the transition. It's very focused on the adaptation to climate perils, and this would also be, in a sense, a way to address that. So with this, we close session 2 on the green insured activities KPI discussion, and we move a bit ahead of schedule, but we move to the third session where we will be touching on horizontal topics, namely on this discussion around the potential introduction of a voluntary OPEX disclosure for the investment KPI, but also quite interesting, and I would dare to say also quite technically challenging issues around the group reporting KPIs and how, let's say, to bring together these different sectoral KPIs together in a single group figure. So to guide us through the initial introduction slides on these last topics, I have again the pleasure to introduce my colleagues Sergio and Ursula. They will guide you through the different topics, and Sergio will kick us off on the first issue. So I'm happy to hand the floor back to you, Sergio. Please go ahead.
Many thanks, Carlos. So as you know, the ESAs are currently assessing the voluntary inclusion of an OPEX KPI in financial undertakings, taxonomy disclosures. We have identified two main issues related to the OPEX KPI. The first one is that the OPEX KPI adds little value, and the other significant issue is that it implies higher cost, higher complexity, and high cost. Having said that, depending on possible amendments to the OPEX KPI, and depending on the quality and the quantity of data, financial undertakings may see merit in reporting this KPI in addition to turnover and or CAPEX KPI, but as said, depending on possible amendments to the OPEX KPI. In that regard, we are exploring a potential solution, which would be combining the OPEX KPI and the CAPEX KPI through a weighted average methodology. But as said, this is again dependent on these possible amendments to the OPEX KPI and the quality and amount of data collected for all the sectors. Against this background, the voluntary inclusion of the OPEX KPI, and we recognize that, may add further complexity while provided limited added value. And considering that, the ESAs will need to assess, based on the feedback that we get from all of you during the public consultation for our sectors, whether amendments to the KPI can provide meaningful insights for non-financial undertakings and consequently providing or becoming of interest for investments, lending, and insurance practices. And as said, we are happy to receive your feedback in this topic today in this public hearing or via the public consultation questions. And with that, I give the floor back to my colleague Ursula for group reporting. Thanks.
Thanks a lot. Yes, so now on the group reporting, very interesting topic, because indeed is about different KPIs and the existing rules. I think we have disclosed them as well in our consultation paper, thoroughly looking into it. So we have the disclosures delegated act that actually provides these sector-specific KPIs, right? So we have non-financial undertakings with turnover, CAPEX, OPEX, and as well insurance undertakings have the sectoral underwriting KPI in particular that is directly in the taxonomy, like non-financial undertakings. Then we have the look-through KPIs from credit institutions and asset managers, and for insurers, the investment KPI. So look-through approaches. So sectoral approaches are different, and not always there is CAPEX, OPEX, and turnover, right? So that's the case for insurance undertakings in particular. And therefore, when we looked at annual reports, we see that there is a mix. There is as well this requirement to have a weighted average of all of these KPIs, which sometimes poses questions of how to use this information. So we are considering jointly with ESMA and EBA that disaggregated sector-specific KPIs put together, they are not so meaningful because they follow different approaches. It's looking at adding apples and pears. So the consultation paper looks at now improvements, and we can move to the next slide to also identify further main issues. So we looked at, first of all, issues with subsidiaries. So the partial disclosure is related to the fact that, for example, the GAR includes insurance subsidiaries, but it uses the equity method. It is also not clear which KPI is being used because the delegated act does not specify, allows to use investments, underwriting, or the combined KPI. So it's by the equity method also not exactly the same information for the subsidiary on the KPI as such. Then, as said, we have a combination of these ratios based on different calculation and approaches, and difficult to interpret them. On the other hand, as well, if we would have subsidiaries reporting at that level, the full template is also seen as burdensome for many stakeholders, and we have observed different practices, actually, how this is implemented. And that's very interesting because we do not see the same practices despite the legal framework. So some follow the rule by the letter, so having all of the templates disclosed at the group level for the also subsidiaries. So for example, banking group, but also disclosing the insurance or asset management templates fully, in addition to, of course, the weighted average KPI that is required. But many groups, in particular, we looked at the insurer-led, and our counterparts, so ESMA and EBA, looked more at their parts sectorally. Primary disclose insurance templates, but not the banking, for example, templates. We have also observed, of course, groups that are mixed, not only financial conglomerates, and when these disclosures on the non-financial parts are also not always the same. So we have identified this as an issue to be tackled, to, first of all, perhaps clarify what should be done. There are different, questions and answers, and the level 2, if there is such divergence in practices, it might be also an issue of interpretation. So clarify what should be done, but actually maybe as well make improvements and proposals to streamline this subsidiary versus parent disclosure, and as well the cases when the subsidiary exemption is acted upon and it's at the group level reported. Next slide, please. So what is the proposal that we are jointly in a coordinated way with ESMA and EBA bringing forward? And this text is equally included in ESMA, almost equally, and EBA as well, although we looked at the perspectives from banking, asset management, and insurance. Also this is affected in the descriptions by, for example, banking disclosures follow this prudential consolidation. That's why there is insurance activities with a equity method, but nonetheless, the proposal is the same. We have them in specific green boxes. You will identify them and you can answer them in the 3 ESAs consultation papers, or in one. We'll also share them among us, a summary of what we get from stakeholders. So we are proposing to, first of all, have disclosure at 2 levels, one at the parent level, as defined as default, and having here the KPI, so the whole template for the activity of the parent undertaking. We have heard that sometimes the main activity is not the parent group activity. And that is an issue where we would like to really as well hear views. Is the main activity as default being the parent? Should that be identified in terms of turnover from activities and might be another activity than the parent activity reported instead? Then the second part as well in there is that some of this is already highly regulated. So this is for financial conglomerates, where it's very clear to identify which is the main activity. Is it a bank-led group, insurance-led group? In particular, these two are the largest types of groups. So that's the first layer, so main reporting on the main activity. And then we have the second layer, which is the additional information for subsidiaries. Currently, subsidiaries can report separately or are included in the group reporting. But we have, as said, identified that often it's very difficult to find this information. What we are suggesting is to have the KPIs for the relevant activities of the subsidiaries, but simplified. So include only the key KPIs. For example, for a bank-led group with insurance activities, it would be the underwriting KPI or investments, depending of the group, and not including the full template. So a simplified version of the templates with some indication. And that could be complemented with some narratives. So in a way, we would depart from the current exemption where this information should be fully included in the group reporting, because it brings a lot of information, but perhaps too much information, and have the headline information instead. Let's move to the next slide to look at how to deal with as well determination of these activities. So by having this default parent activity, this is one option. But we're also exploring in the consultation paper the alternative, which, as noted a bit before, is about looking at what is the prevalent activity. And we hear that that happens often, so it could be an alternative to allow or the flexibility to change the main activity of the group depending on the turnover. In any case, we would like to have in the advice an identification of this main activity determination. Next slide, please. Now we looked at the subsidiaries. So again, here for the subsidiaries, we thought at the moment it's demanding a lot of information for subsidiaries in groups. Some of them would not disclose if they would not be in a group because they would be below the CSRD thresholds. And so in the consultation paper, we are proposing to have in particular an approach of this decision usefulness. So require this reporting where not having it would result in a material loss of information. So materiality being our guiding principle. And as a main criterion, but not the only one, to look at materiality thresholds by a cumulative percentage. So 10% of a cumulative activity. So subsidiaries not by the company, but by activity. If there are different subsidiaries with the same activity and are below the 10%, they would not be included, could not be included in this disclosure and could be skipped altogether, while having a subsidiary one or cumulative in a specific activity would bring them above. Of course, this brings a bit more complexity, how to define the activity, how to group these subsidiaries per activity, what is the main activity of the subsidiary, and so on. But we're looking forward to comments on this, and we think that this is a good direction to have more materiality approach and proportionality as well for group reporting. Then we also included some other criteria which are additional, and all of them could be considered, such as, first of all, whether the subsidiary is acting only for the group. So, for example, that can be insurance, actually, or a company having its own transport, for example, in a subsidiary related to distribution, and so on. So if that is the case, it might be less interesting as disclosure for investors. This information and could be as well skipped. Another factor could be the comparability, for example, with companies that are reporting in the group and that are caught by CSRD requirements and are not in a group. So this comparability is also important. Okay, I think with this we can move on, and we have a final here question, which is going beyond the annual report. So the big picture of the taxonomy is, of course, measuring green activities also for groups, and this is translated as said as well in other tools, financial products, so in the SFDR. It's used to identify investments that are green, right? So in these cases, we need one KPI. And as we were discussing now before, we are proposing to have main activity and subsidiary KPIs, so more than one KPI. In these cases, we would propose the same approach as for the insurance combined KPI, so to look at the main activity and the main activity KPI being used in these cases when one KPI is needed instead of the weighted average. This will not bring a full disclosure, full picture, because it's limited to the main activity, but in a way, it's then very clear what it is, instead of having a mix and an average of different activities that follow different sectoral rules and approaches. So with that, we would like to move to the questions and answers, and looking forward to answering any question you might have on this topic and on the OPEX as well. We have one comment and question, which is very interesting. It's now published from Patrick Geist, observing that the practice already shows that insurance-led groups found a practicable way to report their primary business activity without regulatory requirements and without additional KPIs for subsidiaries. This indicates that insurers already have a solution that provides decision-useful information for stakeholders at the right level. Why is EIOPA of the impression that additional requirements or a materiality threshold are needed? This seems to speak against simplification and risks adding significant complexity. Thanks a lot for your comment, for sharing your view. from the observed practices on group reporting, we see that most of the insurance-led group report only their insurance templates. And we find that there is a gap on disclosing their other activities. That is why we're proposing to add this subsidiary information. So, for example, insurance activities, insurers that also have banking activities, and as well to have more comparability across groups. So, majority of financial conglomerates are actually banking-led. And if we have such a different practices across groups, it's very difficult to have this comparability. So that's why in coordination with ESMA and EBA, we are bringing the same structured proposal. And then also actually, this is more on ESMA side. So we're not, today discussing this, but for groups that have main activities, non-financial, or they don't have any financial activity, it is also important to have similar disclosures and be able to compare financial with non-financial groups. I hope this answers this question. And we have now another question on the investment KPI, which is now published as well from Michael Pylos. Although the call for advice focuses on the underwriting KPI, there would be enough room for further simplified investment KPI beyond the proposed deletion of the disclosures on nuclear and gas. Have you thought about additional simplifications, deleting the further breakdown of the investment KPI, which is not steering decisions from an investor perspective? Very good question. We're very happy to receive other simplifications. I think the core here was on underwriting KPI. The call for advice is open to address the other KPIs, so the investment KPI, and suggest simplification further than this low-hanging fruit, which is the gas and nuclear disclosure. You're absolutely right that the disclosure should allow to steer decisions for investors, and that should be the focus. So very, very looking forward to other suggestions on the investment KPI. Michael, there is a question, I think, on these other simplifications that leaves room to provide comments and proposals. Okay, another question that is now published on simplification. Did EIOPA consider that any change should be simplifying taxonomy reporting, providing a more logical outcome and reducing reporting burdens? So good to look at main activity of the consolidated group, but not introduce additional KPIs. The additional KPIs are not really additional. So if you look at the disclosure requirements, the subsidiary should be reported. So in a way, we are simplifying by reducing this information to only key KPIs, and we have not put a fully fledged proposal, but reducing the templates for these subsidiaries. So this goes in direction of simplification. Just disclosing the main parent activity for very mixed groups would be a problem. So there are groups that have most of the activities, the parent activity or the main activity, and the others are marginal. So that's why we're trying to introduce criteria that would allow for proportionality to then not disclose marginal activity. So materiality focused disclosure. At the same time, if there is a group with different activities and all of them are similarly of importance, just disclosing one activity would perhaps not allow to steer these decisions of investors. So could be useful to have this disclosure. That's why a fully simplification, just main parent activity or main activity, might be too big of a cut in terms of usefulness. Okay, Question from Massimo Romano, and I'm going to publish now first because it's a long question. Now it's published, sorry, I was not finding the button. Under the proposed approach, investors are expected to focus primarily on the group main activity KPI, which reflects its predominant activity and provides the most relevant basis for comparison. Therefore, the decision usefulness of mandating additional KPIs for material subsidiaries appears limited. At the same time, this requirement would increase reporting complexity costs and assurance efforts. This is particularly relevant for many insurance groups, which currently report insurance-related KPIs and generally do not disclose additional KPIs beyond their core business activities. Given the limited expected use of these disclosures by investors, do the benefits of requiring additional subsidiary level KPI outweigh the associated reporting burden and cost for preparers? Good question. All of the disclosures should be guided by the decision usefulness. And so for the purpose of steering investor decisions, indeed, we see, as you noted, that insurers do not disclose often the subsidiary information, despite that they should disclose them according to the regulation. If there is a strong, conviction that only the main activity should be disclosed, we are really very happy to read this in the consultation answers and again explore this, whether this approach that we have is useful. We hear different views on this. I think that many also groups that are asset perhaps less having a main activity, as in the case of the insurance-led groups, find it very useful to have these other activities, or also when the activities are balanced, and also having the insurance activity disclosed in other groups. Therefore, when thinking about cost reduction and proposals, please consider this as what way to find the best solution for different type of groups, not only insurance-led. Okay, are there other comments or questions actually on the proposals? Perhaps on the OPEX? Or more questions on group reporting? Carlos, I'm not seeing more questions coming in to the question and answers tool. So over to you.
No, thank you so much, Ursula, and thanks for the presentation. Thanks also to Sergio, of course, and thank you to all the participants for staying tuned and for the questions that were already raised today. So I think with this, we, as I mentioned already before, maybe we thought there might be more questions, more issues being raised, but we also appreciate that, of course, the consultation document has been released during July, so maybe stakeholders still did not have so much the opportunity to look fully into the paper. But we thank you in any case for the points that you already raised. We encourage all of you to look into the consultation document. And coming, let's say, a bit to wrap it up for today, we are coming to the end. So I want to just say a few words. First of all, to thank you all for joining and for the participation in the discussion. We had over 300 participants at some point in this event, which is, from my perspective, quite impressive on the importance of the work that we are doing here. Although it's very technical, very specific, it's still drawing a lot of interest from stakeholders, and we are very happy with that. We hope from EIOPA side that the presentations and the discussions and the answers that we try to give to your questions, to the extent we managed, were useful, were helpful in helping you understand better the rationale, where we are coming from, but also some of the challenges that we face and for which we hope to get now your feedback and your inputs via the consultation process. So in particular, for the first session, we heard about some suggestions about the denominator in particular, how this could be tailored, how this could be focused. There was some discussion about this and the issues it raises. Also some nice points made about potential enhancement of consistency with Solvency II reporting. And then, of course, for the second item, it was more about the clarification on the methodology, the challenges, the added value. And here is definitely a topic where we would appreciate your feedback. As we said, we have not yet come to a final view on this, and the stakeholders' inputs would, of course, be very much welcome on that. And last but not least, of course, we have the cross-sectoral topics that Ursula was just presenting on, the horizontal issues on which, of course, we are coordinating closely with the colleagues from the EBA and ESMA, but also your feedback there is very much appreciated. Just to say again, as was already highlighted by my colleague Patrick Hodges at the very start, that this public hearing does not replace the formal participation on the public consultation process via the EU survey. And we very much welcome your feedback via that channel up to the 12th of August. We appreciate the fact that the deadline is tight. We did not manage to open this consultation through the usual 3-month process as we would like. And we have to do it during the summer period, which is also not ideal for everyone. But we ask for your understanding in relation to this, as this is necessary in order for then from EIOPA, together with our members, we have sufficient time then to finalize our views, finalize the advice, which we have to submit to the European Commission by the end of October. So we appreciate the challenge, but we thank you already in advance for your participation in the consultation process. Before you leave, and with thanks to my colleagues who are already sharing that slide, before you leave, we would also, of course, always welcome your feedback on today's public hearing. Feel free using the QR code to provide us feedback, what you liked, where you see room for improvement, what you, let's say, would like to give to us as feedback. Please do before leaving the event. Take a couple of minutes. It's usually a short survey just to give us some feedback on how we did today. So with that, I would close it today. Thank you so much again for joining us. We look forward to the further opportunities to engage on this topic. And the first of those will be, of course, your inputs via the public consultation questionnaire. So we wish you all a great day. Thank you, of course, also to the colleagues from EIOPA who presented today, and of course, all the colleagues who are supporting us from the technical side to make this event possible. I wish you all a pleasant afternoon, a very nice day, week, some nice holidays. If you have some coming your way, just please save some time for providing some feedback to the consultation. And with this, I would like to wrap up our event and wish you all a great end of day. Thank you so much.